You're listening to the Practical Wealth Show with Curtis May.
Hey guys, happy December. What I'm going to do, this is going to be a short podcast. I guess birthed from an article I read by the great Kim Butler, co-founder of the Prosperity Economics movement, and some client conversations I'm having as we start to do annual reviews with our clients setting up, the upcoming year. So if you'd like to, have somebody just put this plug out there, if you want to begin to think through next year, a lot of people will make resolutions. And I spend from November, December, I probably over the Thanksgiving weekend on, I don't get into the whole Black Friday thing, but one of the things I did was kind of lay out my, kind of like I did last year, if you want our early episodes of kind of what is my strategy. So I'm already strategizing on 2020. I've already got an appointment scheduled next week with our accountant to kind of lay, all right, here's what we've done this year. We've had a pretty good year. What should we be thinking about? What are some things that we can do to minimize our taxation? And then I'm also planning for next year, trips I want to go on, that kind of stuff. So we'll do a whole episode on that. Because to tell you what I did last year in terms of investing in what number one asset, mindset, skill set, network, that has worked. That works, guys, I'm telling you. And there's no product, even though you need some products, but there's no financial product that assures success. You got to be an expert at something that you can trade your time, your expertise for money. Okay. And then when you get the money, now you can call me because I'm going to make sure you keep it. But I can't steer a parked car. But anyway, what we're going to talk about today is I want to get into some tactical stuff that I find a lot of people get wrong. So a lot of you have life insurance. So we're going to talk about that. And I'm going to get into some what I call principles-based investing against what typical advisors do. But what I want to do right now is I want you to give you a checklist to kind of review your beneficiaries of your life insurance. I find a lot of people, Curtis included, when I was looking through Kim's checklist, which caused me to start the annual reviews to make sure I didn't do this. But most agents don't know how to do this if you've got life insurance from other people, and definitely most people. So I want to walk you through 7 strategies to avoid big mistakes. And so write these down. So get a pen when you get back to somewhere where you can sit down and see, are you making these? And this is a list for you to kind of go over your policies. So congratulations. So you love your family. We'll get into why insurance, because most people say, well, how much does it cost? You want maximum coverage. How much will the insurance company have? Because it's your responsibility to take care of your family. Insurance is a love product. And it's not a need product, it's a want product. You got to ask yourself, what is it that you want to happen? Okay. And then what happens is, insurance is the only thing that guarantees what you guarantee. So you can't only say guarantee in a financial services business, but it guarantees that what you want to happen will happen. So let's look at building a legacy. We're big on legacy at Practical Wealth. So life insurance makes, leaving your legacy gifts simple, keeping them out of probate. So here's one reason for insurance. It's private. It stays out of probate and state courts. It gives your estate liquidity. And so what happens is it will stay out of state courts unless you make these mistakes. All right. So I'll see if I can attach Kim's article in the link. And so what happens is, all right, so I'm going to do them in order. So always keep your policy and beneficiaries up to date. Okay. And see, because often people's estate plans are updated only once a year at most. But when there is a death, divorce, or other major change in family, don't wait. So you need to call the insurance company. A lot of times people are, I've seen people where they've got divorced and let's say they had insurance on the job and they have the insurance going to his original spouse and his kids. But let's say you remarry and you have a blended family or new kids with the new spouse. Well, you don't pay attention to the paperwork. All of your money could still be going to your ex-partner, and you could cut out your current kids and now causing them to have to fight and go to courts and all that kind of stuff. Whereas you just got to review your paperwork. So if you're the owner of the policy, you got to call the company you want to make sure the beneficiaries are get with your agent and make sure that let's review my beneficiaries and make sure who I want to get this money gets it. Okay. 2 is always have secondary or tertiary beneficiaries. So let's say your spouse is the only beneficiary, right? And so you're both in an accident, a car crash. This is kind of morbid, but you got to play defense. All right. At the core, I do insurance. It's my primary product, right? So, and stuff happens because I paid over a dozen death claims. So, stuff happens and people do use this stuff. So you want to make sure that it does what you need to do. If you were in a situation where neither one of you survived, who would be your beneficiary? So if you didn't at least name your children as a contingents, that's a problem because now it's going to your estate. And now it has to be sorted out. And so the ideal beneficiary could be a trust that will receive and disperse a death benefit to other heirs and other charities. See, so, you want to be able to, give to the institutions that are important to you also. If you want, whether you have a trust or not, you'll want to keep all beneficiaries and instructions up to date. So one of the things that we're instituting in our practice is what I call a Dear Partner letter, letting people know. So a Dear Partner letter is just a letter letting people know where stuff is, where the policies are. If you've got like an online filing cabinet or something, what are the logins to that? If you got safety deposit boxes, where are the keys? What are the account numbers? What are the logins to social media? So, because, that stuff has to get cut off. How do you get into that kind of stuff? What are the account numbers? If you got a bunch of different accounts, and let's say your spouse is not on them, how can they get it into that? If you're, for example, you're in business, you're a sole proprietor, when you die, that business is done. I mean, it's not a thing because it's you and you're not there. So if you have like a entity, the business is now separate from you. Okay. And so it can keep running, even if you're not there because it's its own person. So these are things as you start to develop businesses, we always talk about have your own business, but as you develop that assets, you can't get into bank accounts. I mean, it's a lot of stuff. So you need to have, I got a person right now that's like, look, they need coverage and they got a big business. Like, well, your wife can sell the business and, house is paid off. I'm like, dude, you're assuming the house will sell if she wants to sell. And you're also assuming that the business will sell. You're not there. I know 2 people where the spouse don't want to run the business. There's a lot of moving parts and they would love to just shut it down because it's a lot of stress. There's a lot of stuff going on, and yes, okay, business may be doing $1 million, $1.5 million, whatever, or 600,000-700,000, but you are driving that. So if you're not there, then you've got to replace that. Okay. And then make sure that is going to the proper place. So I'm sorry, I'm mixing 2 different philosophies in there. So I'm talking about the need for it. I'm going to stay on the beneficiary thing. Here's a big one that I see a lot. And I've done this, okay, especially earlier in my career. And I'm going to go through and fix this now because most people don't have a trust. And so 3, if you're counting, never name minor children as beneficiaries. Put a trust or guardian in place as a beneficiary. Okay. Here's the thing, because if you name insurance, if you don't name something, the insurance company will be unable to distribute funds to a minor. So it will end up in the courts. And so ideally a trust will distribute monies after a child is old enough to receive funds, depending on the amount. You may want several disbursements. That's why you get with an estate attorney, do you want to give a 25-year-old $500,000? Okay, I know it's a recent situation with that. And I know it's been less than a year. This person has blown it probably half the money already. Okay. All this stuff is a team sport. So if you don't have one, we sometimes use legal service plans, prepaid legal, if you call it, plans, or your company may have that, or you may have a local estate planning attorney. My wife is an attorney here in Pennsylvania. And a lot of times I'll just go ahead and introduce them right over to her. If you're out of state, we have another service for that. But there's things out there. You may have somebody, but it's a team sport. And it's not like a set it and forget it. Estate administration, estate planning is, people come in and out of favor and, your son or daughter that's, out there, if you want to take care of them, then you still have to, I would put it in trust. I wouldn't leave it directly to them because it's going to go up in smoke, if you know what I mean. And so what happens is never name your estate as your life insurance beneficiary, okay, which is a common mistake. And again, naming your estate as the beneficiary subjects life insurance proceeds, which come tax-free, to probate, creditors, and potentially taxes. So again, a trust can be a good solution. Always specify the details. Don't be unclear about, don't be unclear about when you say stuff like, well, my children. Okay. Name them. The insurance company really wants specify the details. So, and a good agent should do this, but, you got to be clear about your intention. So in your app, the company, it's hard to actually do this, but just to say it out there, when you name beneficiaries, you always want to name individual. So if there's 3 kids, then you want to all get equal shares, then I generally would put 33.3, a third, a third, a third, or, 25, if it's 4 kids, 25%, or you want to leave more to the old, whatever. Okay. You have to break it down. Okay. And so you need to have that intention. You got minor shares, you need to name it. Going back to the thing, you want to name the guardian. If you don't have a trust, you can, my mother or mother-in-law add it, as a guardian for blah, blah, blah. A trust is better, right? Because it still goes to that person and they could still just spend the money, right? So because if you don't have a trust, see, if you have a trust, then the money is in the trust. They're going to help your kids. It could be, 6, 7, 8, 13. And so they can still, get stuff, pay for summer camps, that kind of stuff. But, you can kind of have a little bit more control over it, and a little bit more checks and balances, giving a person money and hope they do the right thing. Oh, they'll do the right thing. Yeah, you need to make sure of that. One of the things, if you check out an interview I did with Mark Bertrand, right? So Mark's book, he had a really fascinating story where in his book, he had the parents passed away, and then they had basically they had a life insurance. They left the trust, and they basically put a contingency in there that there would be enough parents, and the guardians had to take for themselves like a vacation, and they put every year, okay, because they appreciate them taking care of their kids because, it's hard work, especially if you're older, you've got your own kids, and now you've got these new kids and it disrupts your family, and they're not, they're teenagers or whatever, they're giving you attitude. And so sometimes you need a break. So you can make sure that you can put enough money in there so that they get a gift every year, $2,500, $3,000, whatever. That $3,000 take to go. Listen, I want you to go to Jamaica. I want you to go somewhere. Make sure the kids are set up, and I want you to spend this on yourselves. Okay. And so that's really thoughtful. I thought that was one of the most best things. So that's out of the book, Investments Don't Hug. I will put the link to the episode in that and hear that to begin to think about the power of the tool of life insurance. Number 6, this is a big one. Never name a beneficiary dependent on government assistance as a direct beneficiary of the life insurance, because that inheritance can disqualify a disabled, otherwise dependent person from receiving benefits. This could be disability benefits, Medicaid benefits, subsidized housing, or assisted living, or other benefits. And you say, well, why does this matter, Curtis? Well, it's disruptive, and it may subject them to a new waiting period or waiting list to requalify for the benefits again when the inheritance is spent down. And even a small gift might force someone whose benefits are tied to housing to move. So chances are that's not your intention. So what's the solution for that? Well, you could create a special needs trust to support your special needs child, dependent or other person, without disqualifying them from receiving assistance. This will allow a trustee to use the money to help them in other ways, paying for expenses that are not covered by their benefits. Okay, that's number 6. That is a big, big, big deal. Okay, And number 7, don't assume your will trumps the life insurance policy. Okay. Because people say, well, I got a will. The will is kind of like the game plan. You're the coach. This is the game plan. So the life insurance funds the whole thing. All right. So you can have a will, estate plan. You don't have no money. There's no estate. Okay. And so the life insurance company will pay the proceeds to the beneficiaries you name in your policy. If you intend to make changes, you must make the changes with the life insurance company. You can't change the will and don't change the beneficiaries, because the insurance company's going by the names in the policy. So when the claim is filed, they're going to say, okay, we need the claim, we need the death certificate, who's the beneficiaries, we're going to contact the beneficiaries, and they're going to send them a check. Technically not a check, but like a checkbook with money in it. And so generally if something happens, you would call the agent. So I tell our clients, call me. Even if they have policies with other companies, I've helped them process it, call the companies for them, all their companies. And just because they're distraught, this is what I do every day. So this is just, fortunately I've had to do it a lot more than I want to, because it's not a happy situation, but I know how to do it. Somebody passed away in my family. It's like, I was telling my cousin, listen, I'm not like frying you chicken and bringing you over cakes and stuff at the, at the repast, or at the, everybody it's in the Black community when people die. I think it's everybody though. People bring over food and that kind of stuff. So, and just sit with the family. So it's like, all right, I'm going to hug you. I'm still clarity. I'm kind of emotionally detached. So I can actually bring a lot of clarity to a situation like that. And I said, listen, I'm not going to fry you chicken, but this is what I'm good at. And I can get this stuff straight for you. And she was like, because this is why you're here, is why I need you. They can do all the other stuff. So that's, who is that person in your family? So you need to make sure that you have a person like that knows what they're doing, that you trust. Ideally, the instructions in your will and or trust will be filled out with your life insurance company. They all match. If they don't, the trust won't override the beneficiary designation in the life insurance. That's the key. So what is your homework for the year? Get your policies out. Look at your beneficiaries. Look at your primary. Look at your contingents. Make sure they're up to date. What is it that you want to have happen? Call your agents. If you don't have an agent that you've been active or out of the business, call me. You can go to to the show notes and schedule a 15-minute appointment, and we'll take a few minutes and I'll help you pull together what to look for. That's it. But this is a big little thing, right? And so thank Kim Butler for putting this out there. So I wanted to get this out to our audience. If you're hearing this and you want to kind of look at some of the benefits of life insurance, email me. I'm actually put a link to a page for this. But if it's not up when this episode goes out, then email me. And I'll send you a PDF of Kim's book, Live Your Life Insurance. And it's kind of like a user's manual. So this is a good time of the year to kind of go through, especially if you're working with us and we've set up, max funded policies. And I always try to remind people because they forget how they work. What is this asset you just bought? So shoot me that. And listen, go out there and make it a prosperous day. Curtis out.
Thanks for listening to Practical Wealth. To access the show notes and resources, go to practicalwealthshow.com. To get your questions on the show, go to practicalwealthshow.com. This show is for entertainment purposes only. Before you make any investment decisions, consult a professional. This show is copyrighted by Practical Wealth. Written permission must be granted before syndication or rebroadcasting.